Everybody, it's Jeff back with another weekly installment of Silver and Gold Market Update. Trying to help you stack gold and silver smarter by creating a track record of physical premiums, the paper markets, the hedge funds, give you a little bit of analysis of what I see in the market as a full-time commodity trader. So let's jump right into it. It'll be a quicker update this week, so there wasn't a whole lot of interesting things that happened. The market's largely kind of chopped around, but there were a few key important points. One, the hedge funds seem to have reversed their selling pattern in silver. For the first time in 6 weeks, they actually bought contracts, and that could be a very optimistic sign. I think they realize that the fundamentals of the actual physical commodity is still extremely tight, and their selling of silver is perhaps not that smart. And we've seen a small bounce. Silver traded all the way down to $24. It's back up to 25.35 right now. So a nice little bounce, and perhaps the bottom is in. As a spec trader in the paper markets, that is a bullish sign, in my opinion. I think funds continue to buy, and they were heavy buyers of gold. As I'll show you in the chart in the next few slides, gold stopped at a very key level where it should have stopped, and has since bounced. It needs to exceed a certain level to really get the funds interested, but they were definitely heavy buyers this week. And maybe a lot of this was because the whole interest rate rising at a rapid pace have leveled off a little bit. That might be temporary. Who knows? It's hard to forecast just where rates will go, and therefore the dollar. So looking at the week over week silver, the premiums have remained constant at APMEX, still at $10 over, which is up of $1 from about 4 weeks ago. As you can see, it was $9 back in March 19th, and it's at $10 now, effectively keeping the spot price unchanged, which is a very good sign. You want to see paper or the premiums go up as futures go down. And now that futures are bottoming and perhaps turning higher and funds are buying, if we see premiums stay constant, that's a bullish sign. Add to that, JM Bullion is actually now 1070 over. It's more expensive to buy a JM Bullion than it is at APMEX, which is quite rare. It's one of the first times I've seen that in all the weeks I've been tracking this, which again reflects just how tight the actual premium or the physical market is. Looking at the charts, as you can see, we did trade all the way down to $24. We're bouncing back. In a perfect world, we exceed that trend line back about 27 to 28 bucks. Maybe we'll get there. For now, it's just kind of a choppy pattern. This is the dollar chart. It's extremely important. If you stack silver and want to know when to buy, you want a high US dollar to buy cheap. And if you want to sell, you want a low US dollar, because where the dollar goes, if a dollar goes up, commodities go down and vice versa. So, but the dollar is based on interest rates relative to the world. And we've seen our rates level off, which has kind of killed some of the enthusiasm on the bullish side of the US dollar. So really, silver's looking pretty bullish right now. The physical market premiums are neutral in the sense they haven't changed, but the JM Bullion increase I find it quite interesting. The hedge fund positions, the fact they actually now are going long. What I've noticed with hedge funds, they tend to, if they're starting to buy, they will continue to buy for 3 to 5 weeks. I follow hedge funds religiously and have for about 15 years now as part of my full-time job. And they tend to trend a certain way. They don't just buy for a week and then sell the next week. Most of the time, they'll sell for 5 weeks or buy for 5 weeks. The dollar index, it's so hard to tell right now. It's a neutral-ish pattern in the charts, and silver, at least, is somewhat neutral. Looking at gold, as you can see, the premiums are still at 180 over at APMEX. And actually, JM Bullion dropped theirs just slightly. It was down 15 for the week at 165 over, which is still extremely high. As you can see, gold was up just $8, which I do find it a little interesting that funds, you could see about 23,000 contracts, and gold was up just $8. You go up to the second row and near the top, and funds sold 20,000 and gold was down 44. So $20,000 contract swing is a big swing, and typically that's going to move gold more than what it did. So my guess is when gold traded down on this chart, you could see it trade all the way down to 1675 and held, which was an extremely important level to hold. I think that's where most of the fund buying happened. and we since rallied almost $75 from those lows, and we're up against that key level 1763. That is a really important level, and I can promise you, knowing how the funds trade, if we could get gold above 1763 on the paper market, they will come in and buy heavily and push it probably up to 1800, if not 1850. So a lot of the paper traders are watching that key 1763 level. So to kind of summarize, the market premiums are neutral at this point. The funds, I think, are still bullish. They've been buying for 4 weeks now. The dollar index, again, is somewhat neutralish, and the charts are optimistic. I'm hopeful that we break above 1763 and get this market moving. So we shall see. That's all I have for this week. Thanks for watching. Take care.